India's trade deficit narrowed in January, hitting its lowest in a year at $17.75 billion. The moderation in trade deficit came as both merchandise exports and imports contracted for a second straight month. Merchandise exports dropped 6.5% year on year to $32.91 billion last month. The reason was a slowdown in demand from key developed economies. The decline was 4.5% on a sequential basis. Imports declined 3.6% year on year to $50.66 billion. The government's curbs on non-essential imports, easing commodity prices, and weak domestic demand were behind this decline. At 13%, the decline was sharper on a sequential basis. So, how do experts read this moderation in the trade deficit, and do they think it's a cause for cheer?
See, the fall of the trade deficit, for whatever reason, is always a cause for cheer. And given the fact that this is one of the lowest that we have witnessed in the year, I think it's definitely a positive sign. But I prefer to look at cumulative data rather than single months, because in a single month, we could see certain things happening which cannot be replicated in future. But if you look at the 10-month period, the overall trade deficit has actually gone up by around $80 billion. So I think that would still be a concern for us. It's higher than what it was last year. And therefore, I mean, we can be cheerful about the fact that for one particular month, it's come down, but it needs to be sustained, on which we're not quite sure about what direction it will take.
Trade deficit has certainly come down in January. And that is on the back of a steep decline in imports. But that decline in imports is happening only in case of gold and silver, substantially. As long as we see trade deficit declining, there's a cause for cheer in the context of rising current account deficit. But one also has to see the larger picture, which is that between April to January, the trade deficit this financial year, trade deficit is almost double that of the corresponding period last year.
Also, is the moderation in trade deficit a blip, or will it continue?
See, it could be a blip. Actually, it's hard to say at this particular point of time, because the trends always point to exports and imports both coming down. And we've also seen that global commodity prices have eased. India is typically a larger importer than exporter. So as prices come down, there would be a greater benefit for us. And that's one of the reasons why we're seeing the trade deficit narrowing in the month of January. So it could be happening again. On the other hand, given the fact that India is going to be one of the better performing economies, growing at 6.5% next year, the demand for imports is going to continue. So that's why I feel that this trade deficit is going to continue to be under pressure, even in fiscal 24, as imports continue to grow, as the demand for non-oil imports keeps increasing, and exports could be slowing down further on account of the recession in the West.
The trade deficit is also happening because exports are not growing, and exports are not growing because of the global situation. Our export sector being import dependent, or the manufacturing sector as a whole being import dependent, if exports slow down, if the foreign demand slows down, then the manufacturing is also going to slow down. And we are seeing some indications. December, we saw certain concerns about the manufacturing growth. So the manufacturing sector will also slow down, and imports will come down. So I think there'll be a moderate increase in trade deficit going forward, and therefore the current account deficit. But I don't think it's going to be as large.
On 15th of February, Finance Minister Nirmala Sitharaman said that discouraging imports for self-reliance was not a good idea. She added that this was because several MSMEs and large manufacturers needed to import inputs and critical components. With the risks rising on the external demand front, the government is concerned about the current account deficit. This has brought the focus back on curbing non-essential imports like gold, which contributes significantly to the widening CAD. Imports of the yellow metal declined 70.7% to $697 million in January. India's CAD may have reduced in the December quarter. This is because pressure from negative net exports eased during this period. In the September quarter, CAD had touched a 9-year high of 4.4%, rising from 2.2% in the June quarter. Against this backdrop, what do experts have to say?
I see that CAD actually remaining in this region of around 3%. We could actually be crossing the 3% mark for the full year of 2022-23. But next year, there could be a bit more comfort in the sense we could be coming down below 3%. We're looking at a number of between 2.5% to 3% for next year. But it all depends upon the China factor also. And I say China factor is important because today when we say global commodity prices are down, it's one of the reasons is that China was closed for a very long time on account of the zero COVID policy. And today, now that they've opened up, and once China starts entering the market, everything happens in a big manner. There could be an upsurge in terms of commodity prices, in which case I think our imports will get affected more, while even our exports will benefit. But then definitely, I think we could be expecting pressure further on our trade deficit and hence the current account deficit. So therefore, we're looking at a number of around 2.5% to 3% for next year.
In spite of the RBI governor's assurances that the current account deficit is eminently manageable, it may emerge as the primary cause for concern for policymakers in the coming financial year, given how uncertain the trade component is expected to be.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.